Hello everyone. Um, Today's video will be over credit reports and really just how to read a credit report. We'll go through a sample copy of a credit bureau report, and at the same time we'll go through the information on this PowerPoint that coincides with that. This will also go in conjunction with the video on getting an 850 credit score and biggest consumer financial mistakes when monitoring your credit and trying to improve it. Now, the three credit reporting agencies are TransUnion, Experian, and Equifax. And it's important that when you're checking your credit, you go through all three of these reports. And the reason is because some companies pull reports from maybe just TransUnion and others just pull from Experian. A number of years ago, my wife and I were trying to get a loan or refinance, and my wife had some inaccurate information on her Equifax report that we weren't aware of. We hadn't seen it before, and we ended up having to file an amendment with Equifax to improve that or remove that from my wife's credit report. Now, most companies, when they file or have a loan in, will report to all three credit reporting agencies at the same time. Others, though, will only report to one credit agency, and that's what happened with my wife. Whenever we tried to obtain credit through TransUnion or Experian, the information was accurate, everything looked fine, but on Equifax it had a loan on there that should have dropped off many years ago. So again, it's important to look at all three credit reports from all three different companies. Again, this will be on a midterm and final exam. The three credit reporting agencies are TransUnion, Experian, and Equifax. Now, your credit report is different than your credit score. Your credit score is actually, in this day and age, is usually compiled by a company called Fair Isaac. And the old score that used to be looked at was a beacon score that Equifax actually created. But again, now, most of the time when we say credit score, we're talking about your FICO score. And again, this is different than your actual credit report in that your FICO score is just creating sort of a risk assessment from your credit report. It's just a number, just a score, and it ranges, I think, anywhere from 350 to 850. And the higher the score, the better credit you have. And it also coincides with your level of risk or credit risk that's associated with you. And again, based on your credit report. So the higher your score, the lower risk you are, and the lower risk you are, the cheaper interest rate you'll usually pay on a loan. So it's always a goal, again, to improve your credit as much as possible. So today we're going to go through and look at a TransUnion report. Now, it really doesn't matter what report we look at. They all contain about the same information. So we'll go through that one and take a look at all the information. Now, what you're usually going to find in a TransUnion report, or most reports, starts with personal information. Your name, any aliases, things like that. Then we get into special messages, your credit score if you've ordered one, credit summary, public records that include civil judgments and bankruptcy, collection activity, trade lines, credit inquiries, and consumer statements. So I'm going to go ahead and switch this over. So we're looking at the report. We have that here, and it's not important that you can read every detail there because I'm just going to kind of show you where the information is at. So the first piece of information that we see on a credit report is your personal information, and it will have your name, social security number, current address, past addresses, date last reported, date of birth, phone number, and any employers. And again, it may have past employers on here, and your job title. So all this information, again, is usually up here in a top box and that, and you want to make sure that that's correct. The one thing where you could run into trouble on this is the address. Oftentimes, especially if you just moved, the present address will be incorrect. So when you move, one of the first places you'll want to contact is the 3 credit reporting agencies, especially if you have to go in and borrow money. And the reason that's important is if your present address does not match the address that's on here is your present address, or your current address isn't the same as this, you can run into a problem. So if you're filling out a loan application and you have a different address than what's seen here, that's kind of an indicator to the company or the bank that you're borrowing money from that they better look at this a little more closely. And their concern usually is this person trying to commit identity fraud and borrow money that's not actually in their name, or borrow money based on a report that's not actually in their name. So again, when you move, you'll want to make sure this is someone who you contact to update the information. Now, if you, like, let's say myself, I have a mortgage through Quicken Loans. If or when I were to move, they'll usually update it on their system, which will in turn update TransUnion, Equifax, and Experian when they're reporting on this. So again, we also have AKAs or aliases that can be found on here. Now the next portion of the credit bureau is special messages and your credit score, again, if you've ordered it, and that's down here. All right, the special messages include identity disparity alerts. For example, the address of the subscriber doesn't match the TransUnion report. So again, down in here, you would see this on there. Or a fraud alert's been put on there. The given Social Security number is either non-existent or has not been generated by the Social Security Administration. Again, these are all alerts telling the person that's reviewing the credit file that something doesn't add up here. The information is not the same as the intended borrower. So, and again, lastly, we have your credit score. Your credit score typically ranges anywhere from 350 to 850. And the higher your credit score, the lower risk you are, the lower amount of interest you'll be charged. And this is just an example of how credit scoring has worked from the standpoint of a financial institution or a bank. And what they'll do is, based on your credit score, they will tier you into a classification of risk. So a Class A credit score would be 720 and higher, and this is an example of a car loan interest rate. This person, being low risk, would receive the lowest interest rate on that. Now, I'll probably say it again later, you actually cannot be denied a loan because of your credit score, okay? You can't be denied for a loan based on your credit score, but you can be denied for a loan based on the information that's in your credit report. Now, the information that's in your credit report actually is what's used to compile a credit score. So, but again, technically, from the standpoint of a bank, you can't deny a loan based on a credit score. But what they use it for is to tier the level of risk you're in. Now, how this works is your credit score gives the bank information of the level of delinquency rate for people with similar scores. So if you have an 800 or higher credit score, your delinquency rate is 1% or less. If you have a credit score of 500, that means about 71% of the people, the population in there, of this 5% are delinquent on their loans. Okay? So again, this is kind of interesting information. Now, one of the things that I've done in the past is I actually invest some of my money into what's called peer-to-peer lending. And peer-to-peer lending is kind of gets rid of the bank or the middleman, and instead you can loan your money directly to a consumer that might be trying to pay off credit cards or something like that. And you can do so and figure out your level of risk based on a chart like this. Now, the higher risk you have, the more interest you'll get paid, but so too will be the higher delinquency rate. So you do question whether or not you're going to get paid. So these are all things, again, that a bank or somebody that's extending you credit will look at. Now, if you have a credit score below 640, typically we classify those folks into what's called subprime. Now, subprime simply means much higher risk. These are folks that have had problems with their credit, have failed to pay back on some of their loans, things like that. Now, another example would be somebody going through a bankruptcy. So if you're having to file for bankruptcy, or you're just getting out of bankruptcy and you're trying to rebuild your credit, you might go to a subprime lender to get a credit card or other type of loan to start building your credit. Now, typically those folks that have a 640 and below credit score have usually limited debt experience. Might be one cause to having this low credit score. Or these folks usually don't have the possessions of property or assets that could be used as collateral. They may in the past have had excessive debt, or the known income of the individual or family is unlikely to be enough to pay the living expenses plus the interest plus the repayment. Another cause to such a low credit score would be the history of late payments or missed payments for other loans that person has. Then we have failures to pay debts completely, or another way we call that is defaulting on it. And any legal judgments such as orders to pay or bankruptcy that's found on the credit report may cause that score to be low. In other words, those that have a score of 640 or below are usually considered higher risk. Now, somebody always asks me the question, well, what happens if you don't have any credit? And later on, I'll tell you a quick formula to build your credit as fast as humanly possible in order that you can increase that. Now, typically, community lenders, smaller banks, community banks, will look at the fact that if you have usually either a low score or no credit, so you don't have a score, they may want to start borrowing to you either way, but they'll use other things like phone bills and other records of that nature to try to figure out a credit risk or risk associated with you as a lender. This is also something that we think kind of caused the financial meltdown in 2007, 2008, was what's called subprime mortgages. And the argument typically was that you're loaning out money to people that had no right borrowing money. Another common phrase or common term would be that's like giving alcohol to an alcoholic. And I suppose there's some truth to that, but we're not going to get into the moral of the whole thing. We're just going to talk about what these are so you're familiar with them. The value of U.S. subprime mortgages was estimated at $1.3 trillion in March 2007, with over 7.5 million first lien subprime mortgages outstanding. So quite a few. Now, one of the other reasons people would get into these subprime loans is they usually didn't know any better. In other words, they had a high credit score, but maybe they'd heard of Countrywide Lending and Associates, so they contacted them to see if they could borrow money. And the loan officer, mortgage broker, kind of just pushed them into a subprime loan, even though they maybe didn't rate one. The next piece of information that you find on is probably the most important information is your credit summary. Now, in your credit summary, you'll have all the different loans that you see in here. That's primarily just this. You'll have all of the different loans you have kind of broken up into a table, and it will show which ones are revolving. Now, revolving credit is like a credit card, and the opposite of that, or we think of as an installment loan. That would be like a student loan. Revolving means it's going to go up and down, similar to a credit card balance. Within that, they usually have a high balance, which shows how much it's sort of in the last year, last 3 years, how much has been the high balance that you've tapped in a credit card. Now, an installment loan, that would just be simply the amount you borrowed. Then it'll show on there your total credit limit. That's the limit that you can borrow, again, on revolving credit. Then it's going to have balance, which is the remaining balance that you have on there on your credit card that you still owe. And then it will show any past due amount if you're forgetting to make payments. Lastly, they'll have the monthly minimum payment listed here. Next type of account that you could see on your credit report is an installment loan, again, like a student loan or vehicle loan. Now, those balances are not revolving, so the high balance is going to be however much you borrowed. The credit limit will be not applicable on there. And then the balance owing is how much you have left to pay on this principal amount. Give me 1 second here. So the next part of the installment loan would be the past due. Typically, you're not going to be past due on an installment loan, or in this case, not applicable. And again, the minimum monthly payment, or just the regular fixed payment. The other type of loan you will have on there is a home loan or a home equity loan, depending on your circumstance. And if it's a home equity loan, then you would have a credit limit and a high balance of how much a balance, and may even have a high balance for an equity loan. Now, on TransUnion, they have revolving, which is like a credit card. Then you have a home loan or home equity loan, which is a little different, and usually different than a mortgage, in that this is tapping into the equity in your home to borrow off of. And then the monthly payment, again, will be the same. Then what the credit bureau reports will do is they'll total all this up, and that's good information for you to look at to see, well, how much are you actually in debt? Now, the big piece of information that bankers are interested is this monthly payment. So what a banker will do is they'll look at this monthly payment relative to your gross income to figure out your debt-to-income ratio. Now, again, if you give me 1 second. All right, so again, we look at this number compared to your gross income to figure out what your debt-to-income ratio is. The one thing to note is most banks and lenders will not lend to you if your current debt-to-income ratio is over 40%. That's typically the threshold, again, where most lenders will not borrow any more money to you. And that's usually on a back-end ratio. So if we say $1,950, and I'm going to do a little backwards math here, 1,950 divided by 0.40 for 40%, that means that you couldn't borrow any more money if your monthly income was $4,875 and you already had this amount to pay every month. You would be done being able to borrow any more money. The bank would not extend you anymore. Now, later on, I'll talk about front-end and back-end ratios, especially when buying a home. Sometimes banks won't even look at this for the situation of buying a home, but they'll look at something different. So again, this is what controls the level of money that you can borrow, is your income and your current monthly payments on your debt. So the next piece of information that you'll find on a credit report is any public records. Now, public records include civil judgments in the event you've been sued, or bankruptcy. So if I was sued in small claims court because I borrowed a mower from a friend and then the mower exploded, it was a nice riding mower, and I ended up ruining it or didn't take care of it, my friend may come and sue me in small claims court for $1,500 to replace his mower. If the judge found in the favor of the friend that lent me the mower, then he would order me to pay, $1,500. That's where this would show up, is under public records. And it would tell me the liability, or the amount I owe, the date, and everything else. Also, will show the bankruptcy attorney if you had filed for bankruptcy. Um, and that's also where bankruptcies would be found on here. Now, bankruptcies and negative information like this can stay on your credit report anywhere between 7 and 10 years. And that's why you want to, you don't want to file for bankruptcy or get sued, is because if you're trying to borrow money, you probably won't be able to unless this is 7 years old. Now, this information should drop off, but in many cases, it doesn't drop off after 7 years. And then at 10 years, they may have it on here at 7 years as paid or whatever. And after, I believe it's 10 years, it's supposed to drop off the report altogether. You will want to check it 10 years after these to make sure it was removed. Then the next part we have on the report is collection activity. Now, collection activity is a little different between public records in bankruptcy and civil judgments, but it has the same negative impact to your credit report and credit score. And collection activity would be filed by a company that you owe money to, and they couldn't collect on you. They couldn't get any money. Now, they don't want to go to small claims court and sue you because that's timely and costly and things like that. So what instead they'll do is they'll file a collection from you. Now, another thing they might do is actually sell this to a collection company. In the case of credit cards, that very often happens, where the company will just sell that to, I don't know, Brookings Collection Company and Tire Service, and they'll sell it for a discount rate. So if the company will say, Barnes & Noble says that you bought 40 books on account or on credit, and you haven't paid the full amount, what Barnes & Noble will do is sell this collection to Brookings Collection Company for half the value, because they don't think it's likely that you will pay the full amount. So then Brookings Collection Company will hound you and come after you in order to get the full balance and the full amount. And the difference between what Brookings Collection Company bought it for and what they're going to get from you is where they make their money. Now, one of the things back in the day, my wife had checked out a book, Brookings Public Library, and the book was overdue, and we got a letter from the library, and it said, you owe 10 cents or something like that, and please return the book that she had checked out. And I looked at my wife very seriously, and I said, do you have the book? And if you do, please get it back into the library as soon as possible. And she looked at me like I was crazy or anal retentive or something like that. And she says, why are you so adamant about me getting it returned? And I told her, I said, because if you don't turn this back into them, they can sell this to a collection company, or they can file a collection with the credit reporting agencies. And again, she looked at me like I was crazy and said, oh, they wouldn't do that. And she's probably right. I don't know that the Brookings Public Library would necessarily do that. But when I worked in banking, there were occasions, especially with at a credit card company within this bank, I would see collection reports that had Los Angeles Public Library on there, and in the amount of $22 is what was owed. Now, the impact to your credit score is that can bring your credit score down 100 points or worse, simply because you didn't return a book. So that matters, and it becomes very important. Now, again, not all libraries will choose to file a collection, but I don't think you want to be asking that. And or don't plan on borrowing a book for that long. And if you do, return it. It's very important that you keep that information. Now, again, my wife would sort of look at me and say, oh, you're just being anal retentive, Bruce. My concern is not the collection being paid from the book. At most, that's going to be, what, 10, 20 bucks? And the fine that the library charges, $1 or 10 cents or whatever it is, isn't a lot of money. But I want you to think in terms of if you go buy a house, the difference in interest payments on that. If I go back to this slide here, and we see the difference in credit score, and if that collection activity from the library drops your score by 100 points, and you go from 700 down to 600, okay, you're going to pay an extra 1.8% interest using this table for a home loan. Well, or for a car loan. Well, if you run an amortization table between the difference of these, and you're talking a $20,000 car, you might end up having to pay an extra $800 to $1,000 in interest to the lender because you didn't return a library book. That's why it becomes very important that you pay, again, your bills, you return your books, you do these things because not because of the collection from the library, but because the impact on the interest can be huge. And if you're talking, again, a home loan, house loan, or mortgage loan, you can talk about some serious interest, and amortization tables would show you, you could be talking $30,000. So again, very important that you pay all your stuff on time and you're not playing that game. Last piece of information you'll see on a TransUnion report would be trade lines. And trade lines are similar to the credit summary. And by the way, usually these will have what companies hold these different credit summaries or different loans. A trade line is a little different in that it shows any open credit account with a balance owing or not. In other words, you could have paid off the loan and it won't show up in your credit summary because there's no balance owing, but it would show up here. So if you have a credit card with a zero balance for a while, it might show here because you haven't used it, but it wouldn't necessarily show up in your credit summary. All right. And then the further on down the list here, we have, we have a credit summary. Give me 1 second here. Trade lines. Oh, there we go. Credit inquiries would be the next thing that you'd see on the TransUnion report. Now, the credit inquiries is anytime you're going to borrow money and the person or the lender is going to pull a credit report, it's going to show up here. Now, why that becomes important is if you, for example, are going shopping in Sioux Falls one Saturday, and maybe it's around Christmas time, you're buying gifts and going to a number of different stores, you may hear or be asked if you want to get a credit card and say 15% on your purchase today, get a JCPenney's credit card. Most people are tempted to say, well, sure, yeah, I could go for 20% off. So they'll go ahead and apply and get the card. Well, the thing is, if you don't have any credit, and this happens a lot when you don't have credit, but you're having your credit pulled, okay, and JCPenney's is not going to actually issue you a credit card, well, that goes into an inquiry. Now, if you hit up 5 different stores that day that all offer the same thing, and you're getting your credit pulled 5 different times, that doesn't look good as far as your credit score and your credit report go. And this actually will bring down your credit report. Now, there's 2 different ways this is coded. Some places can pull an inquiry, and it will not impact the actual number of inquiries here, and it won't impact your credit score. I believe insurance companies, when they pull it, it won't affect your credit score. If a landlord is pulling your credit to see if you'll end up paying your bills, I don't believe that impacts it. Don't take that as gospel. I'm not 100% for sure on that, but there are places that it won't impact your score. Another one is if you pull it individually for yourself, it typically won't be found under here and won't matter. Now, the reason it brings down your score is, especially if you're getting them from banks, having your credit report being pulled at banks, the reason it drops your score is it looks like you're out shopping for money. You're short of cash, you need help immediately, so you're going to borrow. And typically when you're in a financially precarious position and you're going to different places to borrow money, that's not a good thing, and that's why it negatively impacts your credit score. So you don't want to go out and have your credit pulled, especially from banks, numerous times in a day, especially if you're just being quoted a rate for a loan. Sometimes it's better just to pull your credit yourself and then bring that into those banks. Again, you don't want to look like you're shopping around trying to get money necessarily. So that is something to think about. Next piece of information, I believe this is the last piece of information you're going to see on the report, is a consumer statement. Now, this is very similar to the special messages that could be on here, except this one is made by the credit reporting agencies. Okay, they formally put that on there, and that's theirs. The consumer messages is in the event that maybe you think you've been a victim of identity theft, you can call up the credit bureau or file this online and say, look, I think I've been a victim of identity theft. Contact this number before issuing any credit. Okay, and again, that's you saying it. Now, the three major credit reporting agencies have 30 days to confirm whether or not this has in fact happened, and they'll contact the lenders that you believe are not lenders you've ever worked with, so the information on there you believe is not accurate. They have 30 days to contact them, they need to contact them immediately. Those institutions then have 30 days to research it and basically try to prove that in fact this is you. Now, a lot of the times they don't, and then once the credit reporting agencies agree and say, yes, you've been a victim of identity theft, then it will turn into a special message at the top of the report. And I'm not aware of other statements you can put down there. I think it's kind of like a drop-down box of things that you can put in there. There's a limited number. And again, the last piece of information is who prepared the credit report. Now, it's important that you check this about once a year. And there is a website called annualcreditreport.com. Is the government's website. Notice when I pulled up annual credit report, all these other websites pop up. The only website that is the official site that is mandated by the U.S. government to pull a free credit report is annualcreditreport.com. That's the official site. Again, annualcreditreport.com. And here you can pull credit reports for all three credit agencies. Now, they're not going to give you a score in here. They're just going to show you the actual report, what we just went through on the PowerPoint there. Now, I believe under here somewhere for $7 or $5, you can actually get your credit score. And that'll tell you, again, how much the banks will charge you in interest for any certain loan. So those are pieces of information that you may want to buy. Once a year, I figure $5, I get that. Some credit card companies like Discover Card will actually put your credit score, what your estimated credit score is, on your credit card statement. And that, to me, is a quick way my wife and I always compete to see who has the higher credit score. And at our peak, my wife and I had an 820 credit score, or I had an 823 and she had an 820, so I beat her, which is really weird because actually my wife has wonderful credit, I have wonderful credit, but she has had a longer credit history. She had loans at a younger age than I did. I didn't have a loan until I was 24, I believe, so... and in the next video, or the video on credit and borrowing, I will talk to you about some of the mistakes I've made about credit and those types of things. But I'm going to go ahead and end the video here. If you have any questions, please feel free to email me. We will get into much more about the credit and borrowing and uses and things like that in the different video. And for biggest mistakes on this, I'd ask that you please watch the video, Consumer Credit Mistakes and the Goal to the 850 video. Again, it's a little tough to watch. You might want to have a cup of coffee. But if you have questions based on that, please go ahead and ask me. Usually we get a lot of good questions with that. The other thing I wanted to talk to you about is what was the little trick I learned back in the day at how to maximize your credit score as fast as humanly possible. As I told you, I didn't get a credit card until I was 24 or 25. And right after, somewhere or right around that time, my wife and I had just gotten married, and we were looking at buying a house. So there's me, there's my wife, and we were looking at getting a house. Not a very good drawer. Okay, so we were looking at buying a house and went into the bank, or a couple different banks, to get quoted loans, loan rates on those types of things. We found one bank where the rates were pretty good, and we started having them compile the loan application and get the information on there. And I got a call one day from the loan officer, and he told me that ultimately we could not use my credit in order to apply for this loan. And the reason was I didn't have any credit, which was a real problem. And again, I'll talk about that story a little later on. So they ultimately just used my wife's credit to obtain this house. Now, that was okay because fortunately she had just, within a year of that, had taken a fairly good job and made quite a bit of money, so we could afford this house without having to pull my credit. That being said, if we had if she had not had that job, I don't know that we would have been able to afford the mortgage payments on the house that we were interested in buying. So again, very important that you build your credit score. It can have a serious impact on you in the future. So anyway, I was having this problem. I didn't have any credit, and I had a buddy that was a loan officer, and a number of actually loan officers at the bank I worked with recommended this sort of technique of increasing your credit. And what they say is, in order to improve your credit very fast, first thing you need is a credit card, and actually 2 credit cards. One of those should be an American Express or a Discover card. Then you need a second credit card that should be a Visa. Pull that down here a little bit. Visa or a MasterCard. Okay, so you want 2 credit cards, no more than 3 or 4 probably for an individual. Not because it won't help improve your credit score, but because it might be a bit much to manage. You probably want to get one of the, well, if you can get both at the same time, good for you. But if you don't have credit, you may have to wait a year after you get their first card. And I should have actually put this as the first card you should get is a Visa or MasterCard, and the second card is an American Express or Discover card. Now, every year, you're going to want to try to get a credit limit increase. So when the credit card company contacts you, and they usually will do it about once a year, you'll want to try to increase that credit limit as much as possible. And after you've watched the other videos on the consumer credit mistakes, they'll talk about a utilization ratio. So what getting a credit card does, and when you raise your limit, you increase your utilization ratio simply by increasing that number. That helps improve your credit and your credit score. So every year, put that in there, get a credit limit increase. The next thing you want to do is only use each one of these cards once a month, and do so for a small amount of money. So what I recommend is fueling up your car with, I say, the exact amount every time. So I did $50 in gas uh, 2 times a month because I'm using 2 different cards, but I only put in the same amount every month. The reason you do that is because it makes life easy on you when you're trying to reconcile your credit card statement and figure out what all you've used it for. If you're only using it once for the same amount every month, same place every month, you know what's going on there. It just makes life simple. So the next thing is you pay it off in full every month. Now here's one of the issues that we have doing this. I've had a number of students that are they get concerned about credit cards. They hear all this negative situations or people getting into trouble with credit cards. And what they'll do is they'll get a credit card, and they've heard, you need to use the card, but you need to pay it off every month so you're not charged interest and you're not forking out a lot of money in interest. The problem is what these folks will do if their credit card bill is due, we're going to say it's due between the 15th and 20th of every month. The drop date is the 20th, and they get it on the 14th of the month. Okay, so they have to pay it by then. That's drop dead day. What they will do, and this is when they got their statement, instead what they'll do is as soon as they made the transaction, and we'll say you made the transaction on the 6th of the month, what they'll do that night is they will cut a check and they will send it to the credit card company to pay it off immediately. The problem that happens is this information is only sent to the credit reporting agencies once a month, and you have to have your statement cut and pay it off before the due date, but after you've received the statement, in order for that information to go in your credit history. And that's a big component of how your credit score is filed. So again, if you have the transaction, you use a credit card, and then that night you cut a check to pay it off so you don't have to, worry about it or forget about it. Unfortunately, if the statement cycle has not happened, none of that information is getting sent to the credit reporting agencies. So you're not actually building your credit. And I've had a number of students that have done that, thinking that they were doing a good thing by hurrying up and paying it off, but they didn't let the statement cycle. So it's very important that, again, you pay it off before the due date. But what I always say is wait to get your statement before you're going to pay anything off. And if it's electronic, wait for that to get sent to you via email so you know that the statement has, in fact, come, and then pay it off before the due date or between there. And that way your credit history is getting compiled and sent. There's actually record of that. Again, otherwise, if you pay it off immediately, there's no record of it. It's like the transaction never even happened. You're not building your credit score. Again, if you have any questions, I strongly encourage you, contact me. I tell you, when I teach this in class, we almost go for 45 minutes answering students' questions. So I encourage you, again, please ask questions. You're paying for this class. Tap into as much information as you can here, and I'll try to answer anything, any and every question that I can. And if I don't know the answer, I'll try to find the answer. Thank you all, and we will talk to you soon.